Good afternoon. My name is Matt Doxa. I run a company called Excelsior Wealth Partners, and we bring you a monthly, what I would call deep dive look into relevant topics in the investment world. Today, we're going to talk about the what you've heard a lot of if you've been paying attention of the switch from public markets to private equity, private credit. Years ago, some of these investments weren't available to mainstream America. As modern technology, as distribution, as things evolve in general, you now have access as an investor to something called private credit, private equity. So let me give you a couple of examples just to put this into perspective. So let's suppose the S&P 500 is a bunch of publicly traded companies that household names. Now, let's suppose there is a whole private market with companies like Twitter that just went to X, Elon Musk, Subway, Dunkin' Donuts, Chick-fil-A, Publix, Fidelity, Trader Joe's, so on and so forth. Some of those companies we would love to invest in as investors as they do a great job. We just don't have access. So let me give you a couple of stats that might help with clarification. 87% of the firms with revenues greater than 100 million in the United States of America are indeed private. 87%. Privately owned firms account for 80% of the job openings. Employment in the S&P 500 companies accounts for 18%. That's 1/8 of the total U.S. employment. So, just a thought. The question is, as our investors ask for some of these holdings, is it appropriate? Should people be in private credit, private equity? And I guess why? So who I have sitting around the table with me today are Jeff Dzwonkowski, Matt Champion, and our very own Lou Geckel. And we're going to take about 20 minutes and kind of tear this apart. So Jeff, if I could, can I have you weigh in on the question of why private equity for our clients?
Thank you, Matt. Private equity, private credit, for the longest time was really reserved for high net worth individuals. I like to think that, to get to that point, they've done something right in their lives. And what they typically try to do is, at that point, once they've accumulated wealth, is to preserve it and generate income from that wealth. I think it's a good idea to kind of mirror what the high net worth individuals have done now that these private credit, private equity markets have kind of opened up to the broader world. So one of the things we really like about them is the true non-correlation to the public markets. Everyone seems to own stocks one way or another. Everyone owns bonds, but it's not always the case that they move in different directions. So we like the idea that the private markets truly offer a non-correlated portion of your portfolio, and that really helps when your total returns, and it reduces the total volatility. So just a stat here. Private credit, for example, over the past 20 years has had about 1/4 the volatility as the S&P 500. And in those same 20 years, had very similar returns. For example, in 2008, private credit was only down about 6% when the S&P was down 37%. And I think a big factor, or something at least to consider in that regards, is that, being only down 6% with a portion of your portfolio when the rest of the world is collapsing really helps out with the kind of behavioral finance. It keeps you invested in your other, the other stocks and bonds and things like that. You don't have to make any panic decisions. And like I said, it kind of keeps you in the game longer. So that non-correlation with the private markets is really beneficial to many individuals. Back in 2022, we got to see a lot of individuals thought their bonds would do well because the stock market was not. Unfortunately, that was not the case. Both stocks and bonds, for lack of a better term, got destroyed. And the private credit market and private equity as well held up much better due to their non-correlation. So it's not to say that every individual needs private credit or private equity, but we do think it serves as a good portion of someone's portfolio for that non-correlation, nature that it provides.
Thanks, Jeff. And I'll kind of piggyback on what Jeff said. I think historically, when people are talking about portfolios, the main phrase you hear a lot of times is a 60-40 portfolio, referring to what percentage should be equities, what percentage bonds. But at our firm here, we've been talking a while that the 60-40 portfolio no longer works just based on some of the things Jeff covered. So what we're trying to do is add an alternative asset class within a stock and bond portfolio. And to Matt's point earlier, private equity wasn't always available to the average retail investor, but there's several different ways to get some private equity exposure. The other thing that I think you really got to pay attention to in the private equity market is who else is investing there. And when you look at some of these big hedge funds, some of these big pensions, the Harvard endowments, all of these big players have some exposure to private equity within their portfolios. I just think it's until recently wasn't really available to the general public. We do a lot of these retirement dinner seminars throughout the year where we review hundreds of client statements, and very rarely do we come across private equity, private credit. Most portfolios that we see are either target date portfolios or the traditional 60-40, 70-30 stock to bond ratio. Very rarely do we see private credit or private equity when we review client statements. Luke?
I'm going to go a little bit different here and talk about some of the appeal that private equity does have. First thing is that there is potential for higher returns. Private equity often deliver higher returns compared to public markets over the long term, partly due to the fact that they can implement changes and improvements within their portfolio companies that can increase the bottom line. It is another form of diversification. As Jeff mentions, it's non-correlated to public markets, so you can get diversification away from some of the more volatile aspects. You can get very unique opportunities. Private equity provides access to investments that aren't generally available in the public markets, which includes early stage companies, maybe companies that are deeply distressed, or buyout opportunities. Another reason is that private equity firms often take an active management position. What I mean by that is they actually can take a managing role in their portfolio companies where they can provide strategic guidance, operational improvements, and help companies to grow and become more profitable, increasing the profit potential. They can be less volatile, which mentioned already, so I won't go into that. It's easier to align your interests. Private equity managers typically invest their own money alongside their investors, so they have some skin in the game, which always helps to increase returns. You can take advantage of economic trends. Private equity can also provide stability and potential upside, strategic acquisition and restructuring. Private equity should be the long-term position in your portfolio because it can take a little bit of time. Longer term and sometimes the lack of liquidity is what happens when you get longer and higher returns. Innovation and growth. Private equity companies often target high growth potential or those in need of innovative solutions. And that can lead to cutting edge industries and technologies where return potential is often greatest. And that's about it for me. I'm going to pass it over to Doc for now.
So let me talk about trends. So like anything, it's been said the only constant is change. The world of finance has changed, right? So the reserve requirements that banks have to keep are huge these days with the stress tests of $50 million versus $200 million, type of banks. It's just a different game than it used to be. So a lot of people are turning to private credit because those private equity firms don't necessarily have the same reserve requirements or the same requirements in general, and they're ready to lend. They're wanting to lend with what Jamie Dimon would say an advantage over some of the banks. When I say private equity, I'll give you an example: Blackstone, KKR, Apollo, Carlyle, pretty household names. If you ever see a 60 Minutes, these companies own a lot of the daily items that you come in contact with, and sometimes you don't even know that they own it. But those are some of the trend lines. Someone mentioned Harvard. If Harvard's using some of this stuff with the private equity and it's helped them amass the one of, if not the top endowment in the country, you got to start to look and say, hey, what's this all about? X years ago, there used to be, from data we have, about 9,000 publicly traded U.S. stocks. There's about 4,000 now. So if there's less and less stocks, to pick from, and I'm Vanguard and I own one of everything on the planet, you got to kind of evolve into where the Wayne Gretzky puck is going. And that might, just be private markets of sorts. If it keeps going in this direction where less and less companies are publicly traded. I mean, publicly traded isn't what it used to be, right? It's a windfall when you hit that gavel and the bell rings and you're now listed, but then it's a whole bunch of nonsense: regulation, forms, board of directors, unruly investors. I mean, if you can make the same money or more and not have to deal with all that nonsense, it's very attractive to a certain company. And you see companies all the time now go from public to private. You saw Elon Musk, as I had mentioned, do it with Twitter, publicly traded company. He took it private. He doesn't have to deal with all the riffraff now. I don't know Elon, but I'm assuming he thinks that's a win for the time being. Wouldn't shock me if he brings that back public. We'll see. But there's just a bit of a take on where trends in America are going. Are you on the right side? We've started using a lot of these instruments in portfolios, and they worked very well for us because of all the things that Jeff kind of mentioned. So we just see it as a necessity to stay relevant as the game has changed quite a bit from, your grandfather's stock market.
Thanks, Matt. One of the things that I really like about the private investment market is it's a little more, let's say, a little easier to assess the true value of what the investments themselves should be. When you're talking about the public markets, the unfortunate reality is no matter what I think of a stock, if I think it should be going up, if the rest of the world thinks it's going down and is selling it, it's going to go down. Could have reported great earnings. It doesn't matter. With the private market, it's a little easier to assess the value. A lot of these private debt companies, they're issuing floating rate loans. If interest rates are going up, you can expect higher interest payments in the future. If they're going down, the opposite. So, private real estate, again, the price of the investment itself is easier to track versus, the value of your home on any given day. So we like that. It's a little easier for us to decide based on what's going on in the economy, the broader market, whether or not we should be invested in the private markets, or more specifically, which area of it. So I think that's really important as, making it easier on the investment decisions themselves. I think Lou mentioned private equity and credit can come in different forms. So there's different types of investment for income. You might want to look towards the private credit market. If you are looking for more aggressive investments, you're going to take on more risk, but they do have distressed debt and things like that. What's also nice about is in the private credit market specifically is they are issuing senior secured loans. So if you do have a little bit of reluctancy towards them, you at least know in the event of liquidation, bankruptcy, something like that, you are first in line to get your money back. So I think that does help put people at ease versus, again, the public market. It's really a toss up on any given day, week, or month. So again, we like that the private markets are at least a little bit easier to value, and it makes it a little bit more comfortable for us to put in our clients' portfolios. Matt?
Thanks, Jeff. So yeah, I'll kind of just end with what I was talking about prior, where a lot of times in the industry, we get to see advisors kind of get set in their ways in terms of how they design a portfolio, and when some of the newer strategies, again, newer to the average retail investor, are available. Sometimes advisors don't take the time to learn about them to see if they're right for their clients. So if you're listening to this, you work with other advisors and you bring up private equity, they may look at you cross-eyed. They may just go back to their historical 60-40 portfolio that we keep referencing. I think Jeff brought up a good point as well. A lot of times with portfolios, when you're designing portfolio, if income is a goal, historically, you would look to maybe use, value dividend stocks. Some people might use annuities to generate income. Pros and cons to both, but this might just be another alternative way to generate some income, create some yield on the portfolio, while also adding the diversification outside of just the stock and bond that we talked about. Lou?
Well, we kind of covered the reasons why to invest in private equity. I'm just going to focus a little bit on some of the different types that you can get into for diversification purposes, investment comfort levels, things of that nature. So what types of private equity are there out there? There's venture capital, which typically invests in early stage companies, often with high growth potential. And they do tend to focus on technology and innovation driven businesses. Buyouts. A buyout is when a group of investors acquire a controlling interest in a company. And whether they do that with a leverage buyout or cash offers, what they basically buy most of the company where they have a controlling interest, and then they can turn that company around. There also is growth capital private equity out there, which they may lend money to established companies that are looking to expand that may not have the actual funds to do that. Also, there are many companies out there that focus on distressed investments with the aim of restructuring and turning them around. Private equity is typically a group of general partners, and they set up a fund where they raise capital from investors that are considered limited partners. Once those funds are raised, then they can invest in whatever strategy they choose. I mentioned earlier that private equity usually has quite a bit of active management. But aside from that, private equity very rarely enters into an investment without an actual exit strategy, a way of getting profit out of the money that they've invested. That's important because a lot of investors don't have exit strategies, and they can provide one there. I mentioned earlier that they typically have higher returns with a long-term time horizon, so it should be for money that's the long part of your portfolio. And I guess that's about it for me.
Nope, I think that was well said. Hopefully that gives everyone a kind of a quick look. I got about 18 and a half minutes or less here of what I would call under the hood of private equity. So if you've heard of it for a long time, if you've heard that folks that have a lot of money make more money in certain vehicles, you might want to put, private equity in that conversation. If you're used to getting a 1.8% 10-year yield or return on a bond in America, or whatever it is, to come in at north of 11 sounds pretty appealing. It's always been said that Warren Buffett, his investments are born on third base, right? So he's not getting standard items. A lot of times he'll come in mass aggregate and get preferreds at a premium that the rest of us are just trying to grind it out. So if you want to call it that, characterize that, put that in that, kind of style box, that's kind of where we, have some of these private markets, at least in the portfolios, kind of all of the above of what everyone just said. So I think that's enough for today. I think that if there's any more questions, as always, just, get a hold of us, call our firm, and we'll walk you through it. But I think, I'll end how I started. The world is changing. Is your investment portfolio changing? Because the world is changing in the sense that there's less stocks and more opportunities and different package, offerings to the public. Are we still driving around with no power steering in a 1976 AMC Gremlin? with no air conditioning, or, is the car basically driving itself these days? Have we upgraded? I'm not saying one's better than another, but I know which one I would pick, in today's world. So we'll leave it at that. Appreciate your time as always. Thank you.